Hi guys, and welcome to Freckle Finance. Today I'm going to talk to you about the buy and hold investment strategy. Essentially with this strategy, you buy an investment and you hold it for a long time. This strategy is based on the idea that overall there is an upward trend within an investment, and it allows for times of volatility. You know, if you lose a lot of money because it's a bad time, like say 2008 when the stock market crashed, there's a lot of time afterwards, as long as you're not about to retire, for that money to be made up. So you don't have to worry about these times where your money really decreases, because it allows for times where your money is going to really increase. Volatility is a word used to describe how large of an increase and a decrease that an investment type has. So if an investment has high increases and decreases, that's usually considered a high volatility investment. When an investment strategy allows for high volatility amounts, that means when your investments start to lose money, you do not pull your money out of the market. You do not sell that. You wait it out. And that's a very important key, because a lot of people realize they're starting to lose money and they pull their money out and they basically just lost. They've just decreased their earnings when they could have just kept the money in and it would have increased again in the future. And it's especially true if your investments are losing money and you're in a well-diversified ETF or mutual fund, that it's probably not a time that you should be withdrawing your money again, because once again, that money will go back up. It's a diversified portfolio, and if it's well diversified, you can be pretty confident that in the future it will increase again. But along the same lines, since this is a hold strategy, that doesn't mean just because your investment is high that you should sell. If you don't need that money right then and you don't need it for years and years, do not pull that money out either just because it's high, because you're going to make more money off that money over the coming years, very likely anyways. So especially if it's a 10-year gap or whatever, it's a good chance that you will make even more money off that. So don't pull the money out just because it's high if you don't need it. As well, the buy and hold strategy can make you more money in the future, because you're not constantly trading your investments and paying those fees to buy and sell them all the time. You buy and you wait. You don't sell, because a lot of times what happens when you sell, you're not using the money. You go and you buy another investment. That's other investment strategy types have that, where they sell a stock to buy another stock, for example, and that means that they're paying to buy it and they're paying to sell it, and this takes that out. You just buy it and you wait and you wait. As well, when you sell an investment, you often have to pay taxes on it. Now, if you're Canadian and it's in a tax-free savings account, you're not going to have to pay taxes on it, but any other type of investment, you will have to pay taxes on the year that you sell the investment. So let's say that you bought a group of stocks at $8,000 and you sell them later on for $10,000, and you didn't necessarily need to buy it yet. Now, capital gains are taxed at 50% in Canada, so that means you would add $1,000 to your income for the year on your tax return. So if you didn't need to sell this, that's $1,000 that you didn't need to add to your taxes, which saves you tax money in the future, because generally when you withdraw your money from an investment account, especially if it's aimed towards retirement, you're also going to be at a lower tax bracket. This buy and hold strategy is very popular with early retirement extremers, because they know that if they have a well-diversified portfolio, they can purchase it and they can, not totally worry-free, but relatively worry-free, invest in that for long term, and then they don't have to withdraw any money until they're retired, at which point, like I said earlier, they will be at a lower tax bracket, meaning that they should have to pay even less taxes overall than if you had kept buying and selling throughout the times. So the buy and hold strategy is a strategy that I am using, although if you watched my video on my investment history, it may not seem that way. I started off with mutual funds, I quickly switched to ETFs, but basically I was just trying to find my ground where I wanted to be with investments. But these ETFs that I have purchased, I plan on keeping them in there for a long time. And when I eventually decide to get bonds, it's not like I'm going to sell my ETFs to purchase bonds. I am just going to start purchasing bonds as well. As well, I should mention that currently my investments are all in tax-free savings accounts, so I'm not even doing this at this point for the tax benefit. I simply just don't have to pay the fees, and I'm just confident that the money will increase in the future. If you're wanting to go directly with just stocks and you don't want ETFs and mutual funds, it's important that you do your research, have a well-diversified portfolio, so that you won't really have to sell your stocks. Now, you'll probably have to sell more often than you would if you used a mutual fund or an ETF, but at the same time, you should be pretty confident that you can hold these stocks for a long time. If you find these videos interesting and informative and you want to learn more, please click subscribe as I will be uploading videos every Monday, Wednesday, and Friday. Have a good day. Bye.